Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today for our SD Weekly Metals and Markets Wrap is Dave Kranzler. It is March 16th, 2018. Co-hosting with us today is James Anderson and Eric Dubin. Dave, thank you so much for joining us today.
Thanks for having me on again. I love doing the show with you guys.
All right. Now, I'd first like to ask you about the jobs report that came out, I think, last week. It was February's jobs report, and officially, it's better than any we've seen since July of 2016. The U.S. added 313,000 jobs. Now, Dave, is this actually real news, or are these statistics misleading?
I mean, I myself included, people, analysts, commentators shred the jobs report every month. I mean, it's absurd how fictitious the jobs report is. And it's what cracks me up is that everyone in the financial media discusses these numbers as if those are the numbers. And they're not. I mean, but if we want to just take the numbers as reported at face value, they said there was 313,000 jobs added in February. Okay, so if you dig deeper into the report, it turns out that there were 365,000 part-time jobs added. Okay, so that means there was a net loss of 52,000 full-time jobs, if you do the simple math there, right? So, the headline makes it sound like it's a big, robust number and the economy is strong and humming along and, unemployment is close to 4%. And it's just completely fictitious numbers. They're propaganda numbers. I mean, the most prominent guys that I read on a regular basis that shred the report are John Williams, and he probably has been studying the government statistics and shredding them for longer than anyone out there. So I consider him to be a leading expert on it. And Paul Craig Roberts writes about it a lot now. So, in fact, he linked my article to his website, and then he also did an article of his own. And then you've got, obviously again, a lot of this stuff's kind of, it's well-treaded ground, but you've got the labor force participation rate. And you essentially have about 38% of the working age population, which I believe is defined as between 15 and 65 or whatever it is. 38% of that population in the U.S. is not even considered part of the labor force. So I don't know that anyone takes this jobs report very seriously, except the blowhards that are on CNBC and Fox Business that sit around and dissect it for the entire day. I mean, to me, it's just part of Wall Street's three-ring circus to help promote propaganda that makes the economy look stronger than it really is.
We should also say, too, that the expectations were only for 200,000 jobs to be created in February. Those expectations were as low as they are because of the prevailing trend. And then when the BLS likes to massage the political and market expectation understanding of what our labor force conditions are, it's very easy for them to just focus on the part-time growth of jobs that have flooded our economy and replaced longer-term solid jobs. I mean, our economy has been largely hollowed out over the period since the 2008-9 crash, and Obamacare amplified that.
I'm looking at the Fred chart there, and it literally shows 66% when the crisis began in 2008, and now it's supposed to be down at 63%. And, just a steady, slow slide downwards. But nobody, in average people, they just don't have the time to go into the data to find out they're being lied to. Essentially, they don't, they just don't. And this lie just keeps getting beat over and over and over. And we have to sit here and refute this every week. It's kind of annoying, but that's just kind of the way it is when you're dealing with propaganda.
If people work for just a mere 5 hours, they're considered employed in a 30-day window, and they, that's how easy it is for these aberrations. Never mind the seasonality tweaks that the BLS does and the birth-death model that Dave has talked extensively about in articles and on our show as well. I mean, it's so easy for them to have an aberration number like this, and they have been outed in the past for doing these kind of things for political purposes too. So, like Dave says, people need to not take these numbers without a giant salt lick. They're massively massaged.
So I'll tell you what is more interesting really quickly, because I know we want to move on to a different topic. And I found this link on Twitter. The Social Security Administration publishes wage data every year, and it's lagged. So the latest data is through the end of 2016. So it's for the 2016 tax year. And this is data that comes from the IRS. It's based on W-2 filings. So it's actual data. And I was really kind of stunned when I saw the numbers, but I'm going to talk about it in my short sellers journal this week. But just to give you an example, 55 in 2016, and I assume it's not too much different in 2017, 55% of the wage earner workforce earns less than $34,000 a year. 70, this is again right off the top of my head, it's 77% earns something like less than $55,000 per year. I mean, I was really shocked when I saw the numbers. And, it's different than the numbers that you get that are reported. I don't know if the BEA reports them weekly or monthly, I forget, on their personal income and wage data. Those are, if you go and look at the BEA website, those are basically estimated numbers of workers' earnings. And then they send them through their statistical sausage grinder, and they're not even based on W-2 filings. So, you can get truthful data out there. You just have to dig for it and know where to look for it. I guess one more really quickly. The point here is that if the labor market was as tight and as robust as we're being told that it is, wages would be soaring right now, and they're not. They're flat to down, and on an inflation-adjusted basis, they're down.
And so many of the jobs that are in this so-called 4.1% prevailing unemployment rate that we're being told is our unemployment rate are part-time jobs. They don't pay very well. That's why we see those numbers, Dave.
That's right.
Now, moving on here to another topic you've reported on, David, is the collusion between the big New York banks and the Federal Reserve. Now, people have suspected this for a long time, even going back to the formation of the Federal Reserve. You had a lot of bankers and the Secretary of the Treasury going off to this private island, kind of formulating what ended up being the Federal Reserve Act. First, it was the Aldrich Plan, and then how the Fed is. How it's set up is that the big banks, basically America's banks, own stock in the Federal Reserve. And they say, it's not like normal stock because they can't sell it back and forth and so on. So it's not really ownership. But, I mean, whoever owns stock kind of is the owner of a company or organization. So it's almost as if the banks in the United States own the institution that's supposed to be regulating them. Now, you recently reported on evidence showing even further evidence that there's collusion between the big New York banks and the Federal Reserve. Can you expand on this?
Sure. This was, I thought it was kind of interesting. I think I sourced it from the Financial Times, and it was a study done by a University of Chicago PhD candidate. And that's part of what caught my eye, because it's being my graduate alma mater. I had to see what a fellow geek had to say. But he was able to get a hold of traffic pattern data. And again, it was a few weeks ago, so this is kind of off the top of my head. But he essentially discovered a very high correlation between cab rides that were going between the big New York banks and the New York Federal Reserve right after the FOMC meeting was finished. And so I thought that was kind of interesting. And he traced the traffic patterns specifically to traffic between the addresses of these banks and the New York Federal Reserve. And I don't think it was cookie and coffee runners that were running treats from the banks to the Fed. I think we all know what it was. So, in my mind, it just, again, further reinforces this idea that there's the New York Fed and the big New York banks that own a part of the Fed are essentially attached at the hip.
And we should clarify as well, too, because a lot of people just consider this just ranks conspiracy theory. I mean, anybody in our audience can go to the Federal Reserve Board of San Francisco.org's website and read them discuss about how they talk about the Federal Reserve System. They openly and correctly describe that there are 12 regional reserve banks, and they're privately owned. They're chartered private corporations. People need to understand that that's where the power of the Federal Reserve is, and in particular, the New York Fed. That's right. Where that gigantic trading operation is that's larger than any other hedge fund in the entire world. They manipulate markets. They serve their shareholders, the banks. They regulate the banks, and they also are owned by the banks. The New York Fed is owned by the banks. That's not a conspiracy theory. It's even discussed outright on the Federal Reserve Board of San Francisco.org's website.
Yeah, I believe I've seen it's a 6% dividend that's they're required to pay every year, and it's literally printed on their website. So you have to go deep into the crevice of the Federal Reserve's website. You can actually find that written explicitly.
Yeah, I mean they make the argument that it's interest return to the Treasury and all this stuff, but the reality is that we have an organization that regulates banks that also is partly owned by the bank as a hybrid of a public-private corporation.
I see it right here. It looks like it's a PhD candidate from the University of Chicago who wrote that as far as that data between the taxis and going from the Fed to the banks. But my other question was more about, I think you wrote an article, it was today or yesterday, about Larry Kudlow. It's as soon as I guess he got the job or the gig as being the economic advisor, he was live on CNBC and within a minute or two out of his mouth, he started bad-mouthing gold and then selling the dollar and saying the dollar is, going to go up and all this kind of thing. Why is that guy running his mouth and saying gold immediately? What is that guy
doing? I don't know. I think being inside the brain of Larry Kudlow would be a very scary place.
I mean, but you wrote about him from his late 80s and early 90s experience at Bear Sterns and the type of person that he is. I mean, it sounded pretty interesting. So I figured I'd just let you go ahead and talk about it.
It's a good question. I think he's predisposed to. I mean, he's a Keynesian economist, and he's not even an economist, to tell you the truth. He's not a trained economist. Right. He's a history major from the University of Rochester, and he doesn't have any graduate degrees. As a matter of fact, the job that he had at the Federal Reserve, it specifically did not require a graduate degree to have it. He's really more of a politician and a political operator and a political manipulator. I mean, he started out as a Democrat from New Jersey, and in the early 80s, he's transitioned to being a Republican because that's where the country was at the time, if you recall. I mean, Reagan was wildly popular, so if he was going to try and get a job in D.C., he had to convert to being a Republican, and that's what he did. I mean, Larry Kudlow does and says what's good for Larry Kudlow. And, I'm not really sure why he said sell gold and buy the dollar. I mean, the thing is, there's so few people in this country that care about gold and silver, and especially physical gold and silver. And it's like, why would you even bring attention to it? It almost tells me like, oh, are you a little bit worried about gold, so it helps you if you denigrate it? But there was no reason to even bring attention to it because no one in this country cares about it.
That was the best part. It's the fact that no one brought it up, and he's the first to just shoot it out of his mouth like twice.
Right.
So I said transcript is amazing.
So, and if you look at, he's only operated as a professional during a period of time when there's been tremendous expansion of the money supply and tremendous credit creation. And, interest rates from his time at Bear until now, interest rates have gone from, 15% down to 1.5%, and actually close to zero at one point. So, he only knows how to operate and analyze a system in which money is being printed, interest rates are low, and there's Federal Reserve intervention in the financial markets. And other than that, he couldn't think his way out of a paper bag.
Now, before we let you go, David, if you could give our viewers an update on the precious metal markets this week. You mentioned how Larry Kudlow was saying, sell gold and buy the dollar. What is your perspective, and if you could give us an update on this as well, where gold and silver are headed going for the rest of the year? Sure.
Again, I on a short-term basis, it's impossible to forecast the direction of gold because it's so highly manipulated. But I like to look at a couple things. I like to look at the overall open interest on the COMEX, because the COMEX is one of the primary tools for manipulating the price of gold. And I like to look at what's the flow of physical gold into the Eastern Hemisphere. And fortunately, my fund subscribes to a report from a guy named John Brimlow, and he publishes 3 times a day. And part of his service is reporting on what's going on in India, China, Turkey, and some of the other large Eastern Hemisphere physical gold buyers. And these are buyers that want physical gold delivered. So what I'm seeing right now, and I don't know if I put it on my blog, but I've talked about it with my Mining Stock Journal subscribers. The open interest right now is at the, it cycles between going very high and very low, and it cycles between the banks being very net short and the hedge funds being long, and then that's when the open interest is high, and then it, reverses course while they're taking the price of gold down, and it's been that way for, I've been following the COMEX open interest specifically for about 15 years, and that's the pattern. So right now we're kind of at the high end of the range in terms of the overall open interest. And I'm talking about gold because the positioning of the banks is a little bit different in silver, although it's not as bullish as it's been purported to be, at least at this point. It is getting bullish, though. But at any rate, the net short position of the banks, per the COT report, is still very, very at an extremely high level. And I would assume that through Tuesday, because the open interest popped up quite a bit on Tuesday, I would assume today in the report we'll see an even higher net concentration in net shorts in the banks and a higher net long concentration in the hedge funds. And that's typically precedes a price takedown. Now, gold's been going sideways now for quite a while, and the open interest has been bouncing kind of between, the high 490s and where I think it was around 543 as of yesterday, 543,000 contracts, plus or minus a few. I'm still expecting one more quick washout in the price of gold. Now, it might actually be a violent one. We might see gold go below 1,300. We'll probably see silver go below 16, depending on what the stock market's also doing, because silver's also been correlated to a degree with the stock market recently. And then I think we're probably going to head higher. I mean, we're kind of in a little bit of a lull period for India, but they'll have a seasonal buying period that kicks in that goes through, I think, May or early June. And China's just been a steady importer of physical gold week after week. And I see these numbers on a daily basis in the Brimlow report. And interestingly, Turkey has become one of the most prominent importers of gold this year. I mean, they've been importing a record amount of gold in the last year, and it's continued into this year. And I don't know the numbers off the top of my head, and I just looked at them this morning, but they're continuing to buy a lot of gold. I wouldn't be surprised if they're one of the top 5 gold importers in the world this year. So I do think that ultimately we're seeing demand from in the physical market from the Eastern Hemisphere make it harder for the New York banks and the London-based banks to push gold and silver lower. And one more interesting thing I just wanted to mention, and it's if you look at I'm sure it's the same way if you look at a chart of the Huey index, but if you look at a chart of the GDX index, I mean, the mining stocks have been kind of going sideways now since the beginning of 2017, really. I mean, they've been kind of cycling in a sideways channel, and we're right at the bottom of that channel. Now, a technician would probably look at that and say, well, you know, it could go off a cliff or it could move back higher. But I guess the reason why I think it's interesting is we've had a move lower in gold of about, I don't know, about 40 or 50 bucks recently. And the mining stocks really haven't gone anywhere. So I do think if we get this hit that I'm looking for in the next week or two in gold, and it may coincide with the FOMC meeting next week, the hit in gold that I'm looking for, I'm not sure the mining stocks are going to get hit that badly. And if they do, and if you're bullish on the sector, you need to buy that hit because I think you'll be rewarded.
Those are great points, Dave. I want to amplify on that a bit, too. We hit our peak on gold this year when our Treasury Secretary was in Davos making comments about how it was a good thing for the dollar to fall. It was back in January. That also was when the miners peaked out, and then all of a sudden they started crashing a heck of a lot faster at a faster rate, expressing a shift in sentiment with gold falling. And then gold kind of went sideways like Dave is speaking of right now, and the miners reflected a heck of a lot more pain in advance. That does support what Dave is speaking of. But if we fast forward into his analysis of, the open interest in this whole wash, rinse, repeat cycle that we've talked about ad nauseum for years now, the whole jobs report last week, the setting of a stage of expectations with 4.1% unemployment rate propaganda all sets the stage for the FOMC meeting to continue on with more bullish discussion about, the effort that the Federal Reserve is trying to do to normalize their balance sheet and do a reverse of QE. So, the stage is set for possibly some pretty significant turmoil in the price of gold and silver's market. And I'd agree as well, too. This is, we can't continue on in the way that we have with our markets being as artificial as they have been for now pushing 10 years. And corrections are normal. We're going to see more corrections in the equity market later this year, just like we saw earlier this year. And if there is a big or even a medium hit, I'd see that as a buying opportunity, and I intend to exploit it after the FOMC meeting coming up.
Totally agree. I was going to just make one point. I tweeted out today. I was looking at 2-year rolling data of intraday average price movements for gold, just the last 2 years rolling. And it looks like it's looking similar to like the 2009 to 2013 scenario where the London gold fix was obviously being front run and they were, traders were front running it, and the price would drop in the AM fix, and then it would go to, drop again at the PM fix and dwindle down to the end of Globex, New York Globex close at around 6 p.m. New York Eastern time. And that same pattern is appearing now. It's been appearing for the last 2 years as well. And, it looks like when gold is going sideways or trending lower, that is exactly what's happening. The only difference between now and then is that the price now is going in the morning. It's going up a little bit ahead of the London AM fix, and then it dawdles down the rest of the day all the way to the end of Globex. So if we're going sideways, say for the next few months, and you're looking for times to be buying your bullion, usually around 6 p.m. Eastern, that's the end of when Globex ends, that's probably the right time to be buying based on the last 2 years, the way that the price data has been rolling. It's just an FYI to people. 6 p.m. Eastern, New York time. If gold is going sideways or down, that's probably the right time to be buying.
All right. Well, Dave Kranzler, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you online and any last thoughts you'd like to add?
Sure. My blog is Investment Research Dynamics at investmentresearchdynamics.com. And at the top of that, there's 2 links where you can find information about my mining stock journal and my short sellers journal. And, again, if I'm going to reiterate anything, it's don't, if we get the big smack that I'm looking for in gold in the next couple of weeks, don't be afraid of it. That's where you want to that's where you want to back up the dump truck and buy. And I know in my fund we've got a lot of cash waiting for that hit. So I hope it comes, actually.
All right, once again, Dave Kranzler, James Anderson, and Eric Dubin, thank you so much for joining us this week on this week's SD Metals and Markets Wrap.